This is BizBeat. I'm Junfeng. The recent fluctuations in the Yuan exchange rate have posed questions on whether the Chinese currency will be able to hold its ground against the greenback. But the quick pullback in recent days have once again proven that there's no stopping the yuan from taking its rightful place among global currencies. The Chinese yuan stabilized to 6.65 against the US dollar on Wednesday after falling sharply during the middle of April and middle of May. At one point, the exchange rate against the US dollar tumbled from 6.35 to 6.79, marking an unprecedented 7% downfall in a month. So what exactly are the reasons for the current round of stability in the yuan? The US Fed's rate decisions for the rest of the year have been largely absorbed by the markets. Yields on the 10-year US Treasury bonds have fallen from a peak of 3.14 at the beginning of May to 2.82 on June 1st. The dollar index has retreated from 105 to 101. A less strong US dollar means there's less depreciation pressure on the Chinese yuan. Domestically, things have been looking up as the Chinese economy has been returning to normalcy after the pandemic flare-ups in cities like Shanghai and Beijing. The Asia markets have also regained some of the lost ground in the past weeks. Besides the above factors, the yuan-dollar dynamics also needs to be weighed against other aspects. First of all, yuan's value against the dollar has been relatively strong before the recent swings. Last year, the euro, the sterling, and the Japanese yen depreciated 7.5%, 1.2%, and 11.6% against the US dollar. The Chinese currency, on the other hand, went in the opposite direction and gained 2.3% against the dollar. So last year, a stronger yuan made Chinese products too expensive for foreign buyers. Second, a too fast drop in the yuan value is not healthy for the Chinese economy, as it may cause panic among foreign investors and trigger short-term capital outflow. In fact, the 6.6 to 6.8 level has been the average yuan-dollar rate since China's exchange rate reform from August 11, 2015. It's a reflection of the China-US economic dynamics. Recently, China has boosted infrastructure investment, cut 5-year LPR rate, which is a major reference for housing mortgage rates, and encouraged companies to resume production as the pandemic restrictions are easing. Many economists expect China's GDP growth to bounce back in the second half of the year after some pressure in the second quarter. And that compares to the stagflation risks in the US and Wall Street volatilities. Investors will have a second thought before they move money from China to the US. Investors also understand that China remains the world's largest goods exporter with a huge trade surplus and over $3 trillion of foreign reserves. All of this means that the yuan will remain a stable currency in the long term.